Welcome to the About podcast. Here we explore your financial health in simple and easy to understand ways.
Well, welcome back, everybody, to the About podcast. My name is Jeremy Scott, one of your hosts here, joined ably by Roy Hucke. Roy, how you doing?
I am superb.
All
you know,
right.
it's a really nice time of year, and I really enjoy the cooler air.
Yes, fall is by far my favorite season, by far. It's a good time to have the top down in the convertible, and away you go. It's a good time.
And I'm really excited for the topic today because for all of you geeks out there, this is a geeky topic.
Oh,
today.
yeah, we got it. We got a couple of good things going on. First, we have our first repeat guest. So we are welcoming back Leasa Magnuson of NoCo CPAs. How are we doing?
Doing pretty good.
All right. We obviously were nice enough to you last time that you were willing to come back again.
Yes.
You had to come check out the new digs, if
I
anything
did.
else,
I
right?
had to see the new setup.
Right, exactly. So we specifically wanted to have her back to talk about taxes, everybody's favorite subject, because there's some changes. Some changes already happening, some more coming down the pipe. You may have heard in the news or otherwise about the big, beautiful bill, a very large document that has lots and lots of tax changes in it. I know that got Roy all excited because he loves taxes and talking about taxes.
I love calling someone that knows about taxes. That's what I love.
Yes. So we're gonna keep this a couple of things. We're gonna keep it on a high level and apolitical. I really don't care about what you feel about the bill. It is what it is. The law is the law, and we have to figure out how to deal with it and
How to use it and to make it to our advantage the best way we can. Right?
Exactly. And anytime
Correct.
there's changes or shifts, new opportunities come up, and some opportunities go away. So we're so glad to have you with us.
Well, thank you.
All
It's
right.
good to be
Welcome back.
Yes.
This is very exciting to have you in our studio.
Yes. So why don't we start just little table setting, Leasa, just a little about you in case they haven't maybe somebody hasn't heard the previous episode. Give us the 1 minute introduction to why it is we want to talk to you about taxes.
My elevator speech?
Yeah. Oh yeah.
Oh, yeah. Do you have one? I
No,
want to hear it.
I haven't.
Oh, darn it.
No. So I've been a CPA now for 26 years, and I've been on my own for the last 10. I grew up in Colorado, and I'm small town local,
There you go.
and there's only me in the office. So
Oh my gosh.
So you're a one-woman show.
I'm a solo practice. Yes.
Yeah. And recently you got to spend some really fun 8 hours
I did.
learning about our exact topic today.
I went to a class on the one big, beautiful bill.
All right.
And were you riveted the whole time?
No, but I was writing fast.
There's a lot of stuff that's going to affect you. How are you feeling about, how your clients are going to be able to go into the next tax season with all these changes?
Well, there's a couple things I'm kind of excited about to get the word out for. And there's a couple that I think are a little less exciting. They are a little scary for some of my clients that we're going to have to deal with. And so it's definitely a time to see your CPA talks to your tax accountant. What can I do? Because some of these things we can still do in 2025. And some of them you're not going to be able to next year.
Oh, okay. Okay. Yeah, because we're going to be in some transition time.
Yeah, so it's a big year for like bunching of maybe your charitable expenses because there's some changes to charity that are coming down. And so you might want to kind of think about that. There's some new things out. There's auto interest expense. How do you want to use that? How's that going to work for you? So it's definitely a time I think you should either read up on it if you're a do-it-yourselfer or find somebody that can help you with it.
And if you need help with that, you can see the episode with Leasa on how to attract a CPA.
Right. It's not an easy thing. You're a valuable commodity these days.
And there are not many people droving into your line of work.
No.
We're having a real shortage.
We're getting
issue.
older and older and retiring, and nobody wants to deal with the IRS. And
Clergy are actually weirdly in the same boat. I just learned that for United Methodists, the average age of clergy is 64.
It's a lot of professions are
Yeah.
like that, though, even financial planning.
Yeah.
Right? We have a ton of veteran advisors that are retiring within the next 10 years, and we got to get new people educated up.
We do. So one of the things we were talking about before we got started was just how big this thing is. So why don't we set the table too a little bit there about just the breadth of how big the bill was and why it's not possible for us to talk about every single aspect of it in this one little podcast.
Well, you would ask a question. I don't know technically how many pages it was, but I know it's over 1,000. I think it's close to 2.
Yeah. Yeah. And this is not uncommon for giant federal bills. I mean,
It's not. But the thing I think that bothers me most is I don't think the people writing them or voting on it read it and know what it's done, because there's a couple big loopholes, not loopholes, but there's some gaps in there that we're not covering. We've got almost a whole year where you don't get to take like a casualty loss because they just missed the dates. They just missed the dates.
Yeah. So, and that's the other thing too, is that this is probably going to be a little bit of a moving target. We saw the same thing when the Affordable Care Act passed. That was a huge, giant thing. And, and they had to go back and tweak. So I think even what we have now, the future
definitely.
are going to have to go, oh, oops, we need to change that. We need to tweak that.
They came out with the new tips thing and the overtime, and the W-2s aren't set up to handle what they're making mandatory for you to get the credit for the tips and for the overtime. So there's some limitations this year that are going to be exciting to kind of deal with.
Exciting. I love how you look at that.
I don't think I want my CPA excited. I think they want them nice and bored. So, well, let's dive into a couple things here. We kind of brainstormed a list before we turned on the mics, and I'm curious about this senior discount.
The senior discount
that we talked about, because I know there was some intention in the beginning to maybe change some things about Social Security and how it was taxed, and all of that. And it seems like we ended up in this senior discount thing, and I think that's the situation a lot of people are in or going to be in soon, and probably going to make a difference for them.
Let's define what a senior is first.
Yes,
a senior in this case that we're talking about is someone who is age 65 or older.
Got it.
Okay. And I think
when do they have to hit 65? By the way, is that like
by the end of the year?
So as long
for
as
this
it's by
one's by the
December
end of the year,
31st, then they're counted as 65 in that calendar year.
Yes.
Okay.
So it's a calendar year thing. So
okay.
I think in this case, the senior discount was they wanted to not tax our seniors quite as much, but because playing with Social Security always takes a long time for them to make changes to it, and they couldn't do it by the July 4th deadline they had for passing this bill, they came up with this senior discount. So it's not your Social Security that's not taxed. It's if you're over 65, you get an extra $6,000 credit before you get down to your taxable income.
That's very nice.
So it's a nice little thing.
So
it's going to phase out.
It approaches their whole tax bill, not just their Social Security.
Yeah, you don't even have to be doing Social Security. If you've chosen to not take your Social Security until you're 70 or 72, you can still get this credit because you are over 65.
Explain to our listeners what the difference is between a credit and a deduction.
Good, because I have no idea, and I was just going to ask that. So
I was looking in your eyes, and
I was
could
just
tell.
like, I'm familiar, and for people like me, I'm familiar with things like the child tax credit, things like that. Like that's more part of my life than if that helps set the table at all. If it's something similar.
So deductions come off your taxable income. You just get less income to be taxed on.
Right.
And a credit is helping you pay your tax.
Okay.
So if someone gets that credit, let's say, and they don't actually pay any taxes, do they get money back that they was credited towards their bill that they didn't actually have? How's that work?
That would be a refundable credit, and I don't think this one is refundable.
Okay, so it stops kind of at zero. So there's not going to be an additional money coming even if you're not paying taxes.
Correct.
Okay.
Got it. That makes sense because they don't want to create more cost to the government, right?
Right. But if you're a senior on a fixed income that's maybe not particularly large, it's imaginable that gets your your tax bill down pretty low, if not zero, pretty close to it.
Yeah.
Right. It's going to phase out if you are a single that earns $175,000 or a married couple that earns $250,000.
Oh, okay.
So if you're a married couple over 65 and you have over $250,000 of income, you don't get the credit.
Correct.
And it's $6,000 per person.
Yes.
Over 65.
Yes. It's
Got
a per person
So
one.
if you have a married couple and one's over and one's not, you only get the one person's
Right.
credit.
But if they're both over, you'll get the 12.
Got it.
Right.
That's really important to understand for our listeners and what does apply and not apply. I've already had people calling, by the way, I think it's because my clients like to be educated, but they're like, hey, I know about this additional credit. Can I take more money out of my IRA? Right? Because they're going to have an additional benefits to hedge that against, I guess, if you will, to still end up at the same tax rate. So they're already calling me about those kind of things. Like, oh, we could take a little bit more out this year because of this credit.
Okay.
And it's only temporary, so it's going to expire in 2028.
That was my next question, because I know sometimes these things don't last forever.
So that goes through basically tax year 28, right?
Yes.
So when you're filing your taxes in
29.
April of 29, we're still carrying these rules at that point.
Okay.
Right.
Okay. And there's nothing to say. I mean, sometimes Congress chooses to extend these things or whatever, but it's as it sits today.
As it sits today, it
this
expires.
is a temporary measure for the next few years.
One of the interesting things I found is if you are filing married filing separate, you won't get it. You have to be married filing joint or single to get it.
Interesting.
Really? So that's quite interesting. That's going to definitely change.
That
how
can
things
change the
are
math
filed,
as far
huh?
as how, yeah.
Yeah.
Wow, okay.
And is this applicable for the 2025 tax year? Is this something that we're going to use on this year's taxes, or is it starting?
Yes, we get to use it this year.
Okay. Because I know some things aren't phasing in until later.
Yeah, so the bill has items that are some for 25, some not for 25,
Right.
and then all basically for
This
26
one we get to
forward.
use. This one's good, 25 through 28.
So that may be if you're looking at a required minimum distribution or something like that. If you're looking at taking that end of year distribution, it could change the math.
It's going to help. It's going to change the math a lot for people on distributions or Roth conversions, right? They don't need the income. They don't want the income. They can do Roth conversions and all sorts of stuff that we can still have a taxable event occur, but there's no tax bill due because of the increased.
Shout out to my favorite episode, Roth conversions.
Yeah, you were giddy on that episode.
That was super fun. It was super interesting.
It was.
All right. So senior discount, that sounds good, and fairly straightforward. So I'm glad we're starting there. The other one we talked about just a little bit before too was I know some changes that people were pretty excited about around tips and overtime for more of our
there's no
work.
tax on tips, right?
Right,
For
yeah.
all of them, right?
Yeah,
No,
tip-free,
no.
tax-free.
darn it.
That doesn't work quite that way,
All right,
guys.
listen up,
But that's
tip-
pretty
listen
exciting.
up, tippers.
I did notice, I don't know if this has to do with it, but I got a massage yesterday, and I noticed they changed how they're doing the tips now with that. And apparently, like when you do it online the new way, they get it instantly. And I don't know if that's related to this whole thing or not, but since everybody asks you to tip all the time, everywhere you go, I'm curious what the changes are.
So to not have tax on your tips, you have to have, it has to be on your W-2. So these have to be reported tips.
Well, if they're not reported, they're not paying tax anyways, are they? But that's breaking the law, folks.
Yes, come on now.
It's not where I go, but your tips need to be on your W-2.
Okay.
And on your W-2, not for 2025, but in 2026, there's going to be either a box or I'm assuming a new code that we're going to put into box 14 that will be the industry code that will be issued from your employer. So it's not like you can just go to your tax accountant and say, I'm a waitress and my tips on here are X amount and this is the amount I'm going to need to.
It's going to be the reported number from your employer,
employer.
through the documentation that they are required to give
So
you.
there's like 13 pages of people that qualify for this, and they all have a 3-digit code for each of the industries, and it has to be the employer that issues it. We are assuming that for 2025, it's going to be like an attachment that is with your W-2 that says, I'm in this industry and this is the code to use for the tax preparer. I'm not allowed to choose the code for you. It needs to be something I have from the employer, not the payroll company.
Okay. But so a lot of people receive tips like, sign on the credit card receipt or whatever. So ostensibly the employers know that information. So hopefully they're able to provide it anyway.
Correct.
I would think. But that's really okay.
So then what amount do they get to have no
They get up
tax
to
on?
$25,000.
So if they're tipped $25,000 over the year, that's all reported on their W-2, that's no tax on those dollars.
Let's talk about no tax and what that means, because
Okay,
I
let's
think
do.
there's an issue out there about that.
Clarify.
Because everybody thinks no tax means literally they're not going to be taxed on anything. This is just the federal income tax.
So they still going to pay Social Security and Medicare
Yes,
and all the fun
and
stuff.
state tax.
And
I've seen a lot of people mad that Governor Polis is going to take this away from us. It's not. He's taking it away from you. It's just a rule for federal. If they want to do state, every state's going to have to come through and say, we're not going to do state income tax.
So whatever the current rules and so we're sitting here in
Yes.
the state of Colorado. So the current rules of Colorado stay in effect, not affected by, because the federal government doesn't get to tell Colorado how to
Correct.
tax this
And
stuff.
it's just income tax. It's not your Social Security and your Medicare tax.
Okay.
A lot of people don't know that there's several taxes that come out of their paycheck. They just think of it all as one sum because it comes out at once.
Remind our listeners what FICA is.
It is you're paying into Social Security to receive Social Security when you are elderly.
Which honestly might be probably an okay thing, because if you're not, the more you pay in, the more you're going to get to take out. So if
Allegedly.
but
For now,
but I mean,
under current rules,
It is on a doomed train ride right now that they're going to have to fix. But right now in 2033, 34.
we're Americans, we can fix anything. All right, look at Europe. All right. So we,
And it phases out again when you're single and you've earned $150,000. You're not going to get to do it.
Okay, so if they're making buco tips,
Yeah.
they could not get any of that.
And
benefit.
if you're married, so if you are married to someone that is making a lot of money, it's going to phase out at $300,000.
So joint filer 300,000.
It's got to be joint, not married filing separate again.
Got it. So they can't pull that down if you have a husband making a good living.
Correct.
Wife works on the side, tips.
okay.
They're sorry, you're not going to get that benefit.
Yeah.
Your household makes
Yeah.
too much money.
Got it.
Okay.
And is there a definition of, maybe we all kind of instinctively know this, but was there an official definition of what a tip is? Like what qualifies as a tip? Or do we just all assume we all kind of know what that is?
We are assuming that a tip is what you are paid over and above whatever the invoiced amount is.
Right. So somewhere there's some documentation that I elected to.
And there are specific industries that aren't allowed to have tips or not allowed to report tips, or I'll just say they're just excluded from this. And they're in general accountants, lawyers, and white collar industries are not going to, So you can't put a sign up. I can't say that I'm going to give you a free tax return and tips are highly suggested so that you give me a tip to prepare your tax return and I won't have to pay.
So
Okay,
I know
so-
you're wondering this. I don't get tips either. Sorry.
No. Well, no, actually I was, believe it or not, really, I was sitting over here thinking about myself. So I would just be curious. And you probably don't know the answer. And so, but
Do you have tips on your W-2?
Well, not traditionally, but sometimes like you do a wedding, they'll like, hey, here you go.
So I haven't looked at the 13 pages of codes to see if clergy are on there, but that is where you would want to go to see if you.
Okay.
And then it's going to have to be on your W-2 that you got that.
Yeah,
tip.
if they offer something, usually we call it an honorarium. So that's the word we use for like a funeral or a wedding or stuff. If they pay it through the church, then it will show up on my W-2. But I don't know that it shows up as a tip. I think it shows up as like extra income or not. But I got to tell you, there's a lot of clergy out there who would like to know, because that's the one place we might be able
Well,
to.
and here's the thing for the difference there is if I'm giving clergy money, I'm thinking I'm going to get a donation for it on my Schedule A, and I'm going to get credit for giving.
Not usually for like weddings and funerals. Usually it's just a personal check to me, or it's a check to the church or whatever. It's not usually, we don't usually credit those on a giving
I
statement.
know you don't. I'm just saying an individual thinks
Oh, okay.
that's what they get to do, because I see them bring it in to me and say,
got it.
I gave the church this. I'm like, well, the church's thing says you gave this amount. Well, we got married this year and I gave them a $500, extra. Well, then I have to explain to them that's not to the church. You gave that to the pastor.
Right.
And
Yeah.
there's a big difference there.
There
so
is.
I'm just
Gray
trying to
areas
be
of those
clear
pastors.
There you go.
on what that is.
Gotcha. Okay. So there might be a little like murkiness as far as like, so talk to your CPA.
Well, and churches might have to be more clear
Right.
on how they report that and how they receive that too.
Yeah. Because there hasn't been a reason to do anything other anyway, because clergy are technically considered self-employed, so they don't take FICA out of money no matter what. So it doesn't really matter. So that we don't have to get in the weeds on clergy, but But there may be some edge cases as far as what counts as a tip and what doesn't.
Correct. So,
If you're in one of those weirder industries like I am.
So first, your industry has to be on those published pages before you ever
so
dig around.
He could be completely excluded in some.
So if
point.
he's not on that page 13, no use digging around, no use putting him on your W-2. It's not going to matter.
Okay.
Have to talk to your tax professional.
I should have talked to my tax professional. All right. So tips not completely tax-free. Some benefits, and there are people, you may think $25,000 in tips, but I've actually known some people in my life who, waiter or waitress at very, very high-end restaurants. And frankly, that's not an unreasonable amount. In fact, in a lot of nice places, most of your income is tips.
Mm-hmm.
Yeah. And so if you're making $75,000, as a waitress, right?
Yeah.
And, 40,000 of that is tips. That's going to be a big impact on their taxes.
Yeah.
I mean, how much they get to take home.
It's going to work nice for some. It'll just have to see how it plays out.
Mm-hmm.
Yeah. My only thing is I kind of hope we would do what Europe does and just get rid of tipping. I would be so nice, but no.
That's a different podcast.
Yeah, and it's just never going to happen. We've been trying to. So, all right. So going along with that was also some changes to overtime.
Correct.
And probably some similar confusion out there about like, what does this mean?
And that, I think, is a big problem because overtime has to be according to the Fair Labor Standards Act. And not all states follow the Fair Labor Standards Act. Basically, that act does overtime 40 hours a week. So if your state has overtime for if you work more than 12 hours in a day, you get overtime, which I believe is a rule in Colorado. So
I believe it is, yes.
So there is, I haven't dug into it a lot, and I will have to, but currently we don't think overtime is going to apply in Colorado.
Because we don't follow it?
Because the state doesn't follow the Fair Labor Standard Act for our overtime rules. And you have to follow that as your basis to figure out what overtime is.
Okay.
So in Colorado, if you're working, 3 days in the week and you worked 14 hours, 3 days, then you're ultimately at 42 hours. Did I do my math right there? So you get you wouldn't potentially get anything, or you would get 2 hours by this rule.
So the rule is our overtime has to be figured on the Fair Labor's Act. And I don't know that, I think Colorado says if you're working in the 14, I think they say you have overtime after you've worked 12. So they give you overtime for those 2 hours. Because those are not the Fair Act labor laws, you won't get anything is how it's written.
Because the employers are required to report it as 2 hours 3 times in that week,
yes,
which is 6 hours.
Yes.
But by the 40-hour rule, it's only 2 hours.
There you go.
So you just get nothing.
That's the problem.
So they had to pick.
My.
So they had to pick a standard to write the rules to, and of course they picked the federal standard, the Fair Labor Standard.
And there's only about 6 states that don't follow the federal standard.
So if you're in a state that does, what does it look like?
So you only get the overtime, the excess of the overtime. So if you usually get 20 hours an hour in overtime, you get 25. You're only going to get that $5 is going to count. So
Got it. So it's not the whole.
It's not the whole amount.
Rate,
it's just the
rate.
excess amount. And there's going to be an issue on your W-2 because currently your pay stub breaks it down into overtime, but it does overtime at the whole 25 an hour, not just the excess 5. So there's going to be some changes.
Payroll stuff has to be fixed.
Yes, there's some issues there.
And what's the benefit on that extra 5? Is it tax free? Is it so? But
up to $12,500, it will be tax free.
Federal tax
free,
not Social Security tax free, not
Correct.
Medicaid
Not
tax
FICA,
free,
Correct.
not FICA, not state.
Yes,
Just
Federal
income
tax free for the extra above and beyond what you normally would get
above
paid.
the hourly rate.
Yes.
Wow.
Okay.
That's a much harder number to hit for a lot of people then.
yes.
I mean, if you're only getting, $5 to $10 an hour more, well, you got to work a lot of hours to get that.
Right. And so, some people get double time. So, then that they would get the 20. Some of them get triple. So then they would get the 40. But it kind of depends. But I think the big thing is in your state, how overtime is defined by your state is going to be a big thing.
So the question I would have for you is that for 25 or 26?
It works in both.
Okay,
In
so it
2025,
starts-
the W-2s are not changing.
They're not designed to deal with it.
So you're
So
going to have to
probably
give your tax preparer some grace. We are allowed to do a reasonable method. So we're going to ask you a lot of questions to figure out what that excess is and how many hours you worked at that excess.
And the IRS will check their math if you're audited.
Yes.
Basically is what it comes down to.
And then I forgot to ask this question about the tips one. So the tips one, does that have an expiration date on it, or is that continuing?
Is that sunset in 28
That's sunset
as
in 28.
I don't think it's sunsetting.
So that okay. And then what about the overtime one? Does it have a clock on it as far as, or is it? And if you don't know, just say you don't know.
I don't know for sure on either one of those if they sunset or not.
Okay.
Got it.
Okay.
So overtime, we're looking at a situation where they have to be aware of their state rules. They have to be aware of the reporting by their payroll, basically through their company that they work for.
Yes.
And they need to be aware that ultimately they're only getting the above the normal hourly rate up to $12,500 for the calendar year.
Right.
Do they have a phase out for income?
Yes.
And they do have a phase out for income, and that is
Same
as the last one. So joint income
Well,
above
that's-
300,000. Single filer, what's the number? 150?
150.
Well, at least they kept it consistent.
That is something.
Yeah.
Something.
So and if
Something
you were,
about 150 is magical for them. I don't know.
It's probably where the Social Security they stop collecting, right?
No,
It's
Social
somewhere in that
Security is
range.
170 something now. I
Okay, it's
think.
higher now. Okay.
well, and if you work for like a big company, you got to know that there's like an HR department and a payroll department that's just like mad, working a lot of overtime, trying to figure out, how they're going to understand this and report this
Correct,
and
because
everything.
it's not a matter of it's just going to be coded on your W-2 for 2025. It's going to be extra reporting that they have to do.
Right.
And then by 2026, they're going to have to actually change their software so that it shows up on your W-2.
Got it.
And the W-2 is going to have to change to actually have a box that you put this information in.
Okay. So if you are a tipped employee, if you are an employee that routinely works overtime, and I've dealt with my son, he works security and he works, routinely works a little bit of overtime here and there. And I once heard somebody say that the overtime rules are the most not followed employment rules out there because they don't make sense to a lot of people and nobody really knows when they apply and when they don't. So, it tends to, so this is just going to make it even more fun. And
Yes. This particular one is fun.
The big takeaway, because you hear people say this. So if you're listening to someone talking about these rules, no tax on Social Security, no tax on tips, no tax on overtime, not quite true.
No.
You need to know what that actually means because you can't just blanket it.
Correct.
Yes, you
And
have
these
to.
rules
There's
are
a
a little
definition
tighter.
for what tax means.
There's a big old giant asterisk on that word tax. It's like,
Yep.
why is
Below.
this we mean?
And for all of it, there's limits.
Yes.
And I would say
Everything's
for our
limited.
seniors, the 6,000 credit is really quite nice because it applies
Mm-hmm.
not just to Social Security, but that's what they were aiming towards, but it's helping them in other ways.
Correct. And on your for the standard deduction, seniors get a little bit more for their standard deduction
Is it
because
like
of their age.
1625 as well?
Yeah, and that is not taken away. So this is in addition to that. This
So
doesn't
it-
replace it. This is an extra thing for that.
So in 2025, do you know the number for standard deduction?
No.
I can't remember it off the top of my head either. But they get the
Don't look at me.
The basic standard deduction they get plus 1325
Right.
plus 6,000.
Incredible.
If they're below the income threshold on the
Correct.
6, they get the 1325 no matter their income.
So
right?
we're in a situation where a lot of seniors are just going to be paying very little to almost to nothing.
It's definitely going to help them.
I think
for
that's
sure.
the goal for the ones that are just living off
Yeah.
of their Social Security. I think they're going to be real close to not paying tax at all.
Yeah, and actually, honestly, I like this. There are, there are clergy who opted out of Social Security, so anything you do there, it's not benefiting them. But the $6,000 credit would be,
for everybody.
would help them as well.
Yes.
People who are just on more traditional pensions and things like that. So it makes sense. And I will say, we're talking about a lot of, tip industry and overtime industry. You're talking a lot of like blue collar, working class,
Yes.
kind of jobs. And so you can see, the burdens they're trying to relieve for who. And that
And
makes
this really
sense.
targets your lower income folks too, which is a very nice place to give them some break because cost of goods are up so much that they need some relief.
Yeah.
Absolutely.
All right. So the one that's near and dear to my heart, was there's apparently some changes to charity. And honestly, when we did, I will tell you, living through the transition to the larger standard deduction, which meant a lot of people, no longer, itemized when we made that transition. And it actually didn't affect it as much as I think the charitable world and the church world, you would have thought the sky was falling. You're like, oh my God, nobody's going to give anymore. And I'm like, well, hopefully people give to charities and give to churches because for more reasons than just they get a tax deduction. So it wasn't quite the end of the world everyone made it out to be. But anytime they start mucking around with the tax code around charities, some of us get a little bit nervous. So what I honestly, admittedly, I didn't pay a lot of attention to this, but I had not heard. I'd heard about the tip thing and I'd heard about the overtime thing. I did not hear anything about changes to charitable giving.
Well, first, I think some more people are going to be able to itemize because they've lifted that cap for the $10,000 for the income tax. If you had real estate tax or you paid state income tax, you were limited to only being able to take $10,000 when you itemized.
Oh, okay.
Okay, so they did. Okay,
so they lifted it to $40,000.
Got it.
There's a cap. If you make too much money, it's going to go away. But some more people are going to be able to itemize, and so. I think that kind of when you just had standard, the only thing you were able to do was that 10 for your income tax, and if you had a mortgage, there was that, and then whatever you did to charity. So I had a lot of people that were still being able to itemize because I have some large people that do give a lot to their church or to a charity. So I was really saddened to see that now in 2026, not for 2025, but for 2026, there's going to be a floor on your charity. So you're going to take 0.5% of what your AGI is.
And explain to people what their AGI is.
It's their adjusted gross income.
Okay.
So it's not your taxable income, it's your adjusted gross income. 0.5% of that, and whatever is above that 0.5%, that's going to be your charitable deduction. So you're going to lose 0.5% of your AGI worth of deductions that you give. So if I have somebody who is giving $30,000 to their church, they're only going to get to give, depending on their AGI, they will only get a deduction for maybe $25,000 or $20,000 or.
So if it's not above their, if you're doing that for the that
AGI,
calculation,
yeah.
and their standard deduction is $23,000 or whatever the number is.
So like if you're doing, if you're making $200,000, that's $1,000 you're not going to get to deduct.
Okay. Yeah, that was
if
just
you're doing
starting to rough math.
if your AGI is $300,000, you're not going to get to do $1,500.
Okay. So, but any dollars above $1,500,
you can still
count.
deduct. Yes, it's just you're going to have this floor, and the floor is
That's
going
a
to carry
weird thing.
forward for the next 5 years. But it's going to be a big surprise for
a lot of people.
I was thinking yesterday I got a call from a gentleman who is retired, and he has some RSUs, and so he's always trying to figure out what to do with $1 million.
Restricted stock units, everybody.
Yep. And so when we were like, well, you could give to charity, and he does. He gives hundreds of thousands to charity. But if if he's $1 million and he gets limited to 0.5%, he's going to be limited.
Yeah.
So that's actually a really good thing. So if someone,
So that one doesn't have a cap on it. It's not 1% up to a certain. It's 0.5%, no matter what it is.
floor.
It's a floor.
So if you're $10 million a year person, 0.5% of $10 million. Wow. Okay.
So that's going to impact some big givers.
From big givers. Yeah.
Right. So, opportunity here, let's bunch. Let's take more. Let's take your 2026 at least in 2025.
Yeah. So if you have the ability to bunch and you have that excess cash flow, then you could give it all in 25 for your 26
and get the 100%.
giving.
Yeah.
Get 100%.
And that's actually a great segue too, because the next podcast we're going to be recording is specifically about donor advised funds.
Yeah.
Yes.
And that's a great vehicle to hold that bunched money.
That's what
so
I was.
that
Yeah.
charities don't have to kind of deal with this huge inflow of cash that they don't necessarily do the best with managing that. It's hard to do.
Yeah.
If you get a big number,
Right.
they just want to spend it or.
So I think
do
donor
something.
advised funds are a great thing that we're going to,
It's
I
exploding.
definitely be pushing those.
You're going to listen to that podcast.
When
then.
I talk to people,
Yeah.
I'm like, let's look at one of these so that we can put the money in 2025, get our
Just say no, I can do that. Just
our charity
just wink,
for
wink.
it. And then you can decide who gets it in the upcoming years. So yeah.
Yeah, I think that's going to be a big deal, that bunching concept. So then that doesn't go into effect until 26.
Correct.
Wonderful. So give until it feels good, folks, in 25.
Especially in 25.
So for those that are like smaller, a couple years ago we had one that was 300 and then we had one that was 600 that you got on the front page of your 1040. That's now going to be permanent. So you're going to get that for standard for up to like $1,000 for single people and $2,000 for joint. So you're going to get to do
Did
that.
not follow you on that. Say
Okay,
that
let's
again.
see you're going to take the standard deduction and you're not going to itemize.
Got it.
But you still give to charity.
Got it.
You're going to be able to take $1,000 or $2,000 if it's joint on your and do standard deduction. You're not going to have to itemize to get your charity. So there's going to be like two ways you can get
So you
charity.
at least get some of it.
It's going to be one or the other. If
Got
you're
it.
itemizing, you're not going to get that standard. But if you get a standard deduction, but you still give to your church, you're going to get to give up to $1,000.
So for some people that are on the edge, it might determine whether or not they do itemization or not.
Correct.
And they might say, well, it makes more sense to not itemize because we get this extra $2,000 for a married couple.
And you don't have to deal with the floor.
Yep, you don't have to do it with the floor. Whereas if you're above that, then you're like, well, maybe it makes sense to still itemize. But that's goofy. That is a really weird one because it really does disincentivize larger givers.
Are you calling the tax code goofy, Roy?
I quite happily am.
What's
It's not very logical, is it?
Well, it's designed by committee. So political committees at that.
Well, and then we get to deal with the fallout, right? And like figure out what does it actually do now?
Right.
Right. That's all of us professionals trying to figure it out. And then give them feedback. And then if they're smart, they'll fix it. And if they're not, they'll just, they won't spend political capital to fix it.
Right. I wish that somebody was there that, could tell them, well, in the real world, this is what it's going to do. Yep. It sounds great on paper, but when you apply the technicalities of it, this is where you've missed.
I don't imagine there were a lot of CPAs in the room.
Yeah. And when
I'm
you have
not
deadlines,
volunteering for that
even
job.
for a CPA, right? Like there's the deadlines, there's pressure.
Yeah.
It's like you can't digest it all.
Yeah.
I mean, this is months later. We're finally figuring out all of the fallout.
All right. So the last one on my list that we talked about just a little bit before was some changes for teachers. And I have a lot of teachers in my church, so I was excited to hear that. And
you were excited, and after Leasa explains, let's see how you feel.
Yes, I was going to say.
Take the floor.
So for 2025, teachers are still going to be able to do their $300 deduction.
Which is basically covering expenses that they spend on their job.
So they
their
only
kids,
get
their
up
classroom.
to 300, and we
Because-
all know teachers spend way more than that.
Yeah, we all know that is part of the profession. Is you are supplementing classroom supplies and resources and stuff all the time. It's just part and parcel of
the
it.
exciting thing everybody's heard is now the teachers are going to get to do 100%. Whatever they spend, they're going to get to deduct. The problem is it's going to go on your itemized. It's going to go on your Schedule A. You're going to have to be an itemizer in order to benefit from 100% of your teacher supplies.
And most teachers probably don't itemize with the increase in the standard deduction.
Right. Okay.
Even with the new rules to the charity and the new rules to the state income tax, I don't think teachers are going to get to take all their expenses.
So they're ultimately going to lose out in this situation more often than not, probably.
I think
by not getting any deduction.
Correct. I think they're going to lose their $300.
Oh, well, darn it! I was excited.
It's the way I think it's going to play out, but I could be wrong.
Yeah. Yeah, I get, and some of the changes we talked about might push teachers into that itemized bucket, depending on what else is going on. But is there an income limit on the 100% the teacher can take?
No, it's 100%. And they opened it up to more than just teachers. Now, like coaches can do it, athletic directors can do it. They kind of widened who could take their expenses.
So if you're a teacher married to another professional that maybe does a little bit better, and you have other things that push you into that itemized range, you could still.
Then they'll get 100% of it, which would be nice.
Yeah.
But they're the ones that can afford it.
Right.
And the ones that can't get nothing.
Right. So that's kind of the opposite of everything else we just got done talking about.
Yeah.
So, all right.
That's a bummer. Not a good one for teachers.
I don't like the way that one played out.
We think, again, everybody, we think. Like,
Right. Nobody's filed taxes for 2025 yet. So
Well, and that rule is for 2025?
is it? Oh, might be.
I'm trying to think. It's 300 in 2025. The itemization rule moves to 2026.
2026.
2026.
Okay.
Yeah.
Okay. So would they need to take advantage of it this year? Next year, they may not get it unless they itemize.
Correct.
Yeah.
So
Okay.
teachers need to pay attention to that.
All right. Well, we made it through my list. What other exciting changes from the recent overhaul do you think we would be good for folks to know about?
So the one I'm most excited about that came out, and granted, it's called Trump accounts. So you got to get past the fact that it's named after President Trump if you don't like President Trump. So just forget that. But what is going to happen is for children under the age of 18, you're going to get to open up a non-deductible IRA for them that they don't have to have earnings in order to fund. Because typically when you put money into an IRA, you have to have earnings. Mm-hmm. This is going to be for children under 18. They don't have to have earnings to put the funds in there. The U.S. Treasury is going to seed this with $1,000 for every child born in 2026. I think it's after 2026. And your employer can put money in it, and you can put money in it up to $5,000. It's a $5,000 amount every year that you can put in for your kids.
So $5,000 up to, does that include the 1,000 seed money? Or
That's
is that
the 1,000. So if it's seeded with 1,000, then the parents need to come up with 4.
Okay. That's the total for the calendar year.
If your employer can put $2,500 into it as a fringe benefit for you
per year.
There's some argument on per year. The instructor I listened to said it is not per year.
It's just a one-time thing. So they can seed it with up to $5,000 one time.
Right. It's written kind of gray for that. So it could come out that the employer can do it every year, but definitely can do it for 1 year. So if they gave $2,500 and the IRS seeded it with $1,000, then there's just $1,500 left for the parents to do to get to that $5,000 that first year.
And you said it's non-deductible, so there's no tax benefit today to put the money in.
Correct.
But how does it work going forward once the money's in it?
So there are no withdrawals until the child is 18. So mom and dad can't.
So it's like a retirement account. You can't touch it till a specific age without penalty of some sort, I'm sure.
There's not even until the penalty kicks in when they're 18. Literally, when they're under 18, there is no withdrawal.
Got it. So it's just no.
Interesting.
The answer is no.
Where are they held? Where can they be held?
They need to be invested in, I think, mutuals and ETFs.
So mutual funds and ETFs.
Yes.
At any kind of financial institution, or is this held through the government? Or
no, I believe they're going to be able to open up with people like you, Roy.
That was my point.
Yeah. He's like, he's getting us somewhere. So, okay.
And so you should definitely get one of these open. And if you are expecting a child in 2026, definitely open one up so the IRS puts that $1,000 in there for you.
Or plan ahead, folks. We got time.
There was a lot of that. Plan ahead for it as well. Yeah. Okay.
Yeah. So you can see the kind of goal here, right? Is get that retirement savings early, when you're in that, even in that time of life when nobody's saving probably for retirement under the age of 18,
Correct.
right now. So, but you're looking at, 50, 55, 60 years until retirement. So, I mean, obviously, anything you can put away at those younger years, that's just going to sit there and grow and grow and grow.
So once they're over the age of 18, they can pull it out for education purposes, buying a first home, or starting a business and not have the 10% penalty.
Is it tax-free at that point?
No, it will be taxed at ordinary rates.
Ordinary income?
I mean, yeah.
Okay, so it's
just like an IRA.
So it's money that's never been taxed, but you get no deduction to put money into it, and it 100% is income when you pull it out.
At the kids level, not the adults level.
And it's technically, I guess I'm thinking here, a parent I'm imagining would have to oversee that money, and they can make investment decisions on the money until they're 18.
I think it's going to have a limited amount of investment choices for it.
Got it.
It's going to be pretty safe kind of investments.
Okay.
There's no such as safe, just to be clear for our audience.
No.
Okay, you be clear.
All investments involve risk.
So, and you'll also be able to convert it to a Roth.
Oh, okay.
At what point?
it's
It would be like, why wouldn't you do that day one if that's the truth?
Well,
those are fun
Because you
loopholes. Let's figure out that
you
loophole.
can't have a withdrawal till you're 18.
You could do a conversion because you're not withdrawing.
you could do a conversion, and so it's
would be
a
something
little
to
gray
figure
on
out,
if you can
yeah.
do the conversions. But you know the 5-year rule for holding.
Yep.
Okay, so every time you would convert, that 5-year rule starts over. So I don't know that for a child that can't take the funds out, you want to convert it to a Roth until possibly they're 17 or 18, and then you want to convert it to a Roth would be my thought.
I didn't follow your logic. Because if you convert it then you have to wait 5 years.
Right.
But
So if you do it every year, then like if you put one in when they're 1, then you've got until they're 6. If you convert when they're 2, then you're going to have
But you can't touch it till you're 18. So
the 5 years starts over.
why wouldn't you do it day 1 so it all grows tax free?
Because every year you have to put it into the non-deductible IRA. You can't just keep putting it into the Roth, so you'll have to convert it every year.
So maybe I misunderstood you. I thought you said you couldn't put more money in past year 1.
Oh, every year you can put up to $5,000 in it for the kids.
Okay,
Yeah.
that's what I did
Yeah.
not understand. So
Yeah.
you can put
So-
money in every year.
The IRS isn't going to, and your employer isn't going to, but you can. Mom and
Okay,
dad can put
that's good to
$5,000
know.
into it every
That's
year.
good to know. So they can keep funding it. They get no tax benefit though.
No.
But I don't know. You in my opinion, you would just do it every year.
Yeah.
It's non-deductible, and you would immediately convert.
I think
Well,
that
I
if you
think-
have if you have the wherewithal, I think that you should definitely start one of these for the kids and
Yeah.
put $5,000 in it every single year. Because imagine the growth by the time they're 59 and a half.
Right.
It's
Well, I
doing
think-
absolutely nothing.
Yeah, I think it's one of those things. I think as a parent right now, I'm just thinking, okay, it'd be interesting balance to figure out because we all have limited amounts to give. Like, what do you do for that versus a 529, which obviously has some different tax implications and benefits to it as well. So I think that's my balancing act. I'm like, well, how do you, that's going to be a little bit of work especially, for working with somebody like you, Roy, about, all right, which one of these vehicles?
So definitely if you're saving for education, the 529 plan in my mind is where you probably want to go, because this thing, if they're not going to go to education, they have 2 other options to pull it out and be able to use it for.
Right.
So
right, and then
This is
there's
going to be an interesting one to figure out because of the taxation on it.
well, and that's the differentiator too. It's like, okay, you can use this without penalty for education, but you're still going to be taxed as income.
Which I wonder how that will affect, because if you have a child taking that out for the purpose of their FAFSA, F-A-F-S-A, when they apply, now they have income if they're taking it out of this account, which that will potentially affect what kind of
but if
help
it's
they can
in
get.
the account when they apply for the FAFSA, it won't be
But
counted.
I'm thinking of the next year, right? So after that first year of distribution, how does that
now they've
affect them?
got
Is
some
that
income.
income to
Yeah.
them that then negatively impacts their ability to get help for college?
And the tax is interesting too, because practically speaking, if you're a college student, depending on how much you make, you're probably not paying a lot in federal taxes anyway. Even if you have this to take it out. So, but that's, it's good that there's additional option there, and hopefully you're doing the right, what I would say is the right thing, is that you're putting it in there and you're just letting it sit and letting it ride.
And the really cool thing is that ultimately, and this is one of the things a lot of my clients talk about when they have kids or grandkids, they have so many toys that they don't know what to do with it, and they play with the box instead of the toy.
Right.
Right. So it'd be very easy to start saying, hey, family, would you be willing to put money towards this new account?
Right.
A sum of the money that you were going to maybe spend on them for their birthday or their holiday, and put it into this new account.
Yeah. Like a lot of us, I know I have, and other people have done it. We do that around the 529s anyway, but I think this is another option for, so have they had clarity around, like parent or grandparents contributing to the account for their grandkids, or things like that?
This is an account that is opened in the child's social security number.
So it doesn't matter where the 5,000 comes from.
So basically, if you want to send me money, we'll put it in the account for the kid. That's how that
Correct.
kind of sounds.
Okay, so it can
Anybody could do it.
It can be birthday money from grandma. It can be whatever. It can be
Correct.
wherever it's coming from. You don't care because there's no tax benefits to anybody anyway. Grandma's not getting to deduct that donation off. But right, instead of sending them another toy that they're not going to play with, put $100 in their account now. It's going to be worth way more.
It's going to be something for them in the future.
Yeah,
That's interesting. So you can do it every year, up to $5,000. The first year you get some seed money, potential employer
If it's
benefits.
a baby. So like if you already have a 5-year-old, no seed money.
But so then let's ask that question. So client has, a child that's 4 right now. in 26, they could technically open up one of these accounts. They just don't get the seed money, but they can put in up to $5,000 a year.
Yes.
Because right now, before this, like my daughter's 14, I can't open up like an IRA
No, unless she has earnings.
because she has no earnings to put in it.
And you can't put it in a Roth
Yes.
either. So you could put the money into this. Then when they do have earnings, you could put money into a Roth and this, because you can have the Roth and this at the same time.
Okay.
I'll be excited to see how this works. I'm already thinking that it would. I don't see why it wouldn't make sense to immediately convert every year. I really don't.
Roy is a converting machine.
Well, it's only the 5-year clock only starts on the converted dollar.
Yeah.
So if every year you're doing this, then you're gonna have a lot of money available at 18.
Shout out again to our Roth conversion episode.
Right, but this is a little different. We got to figure out how the rules work
Yeah,
with
yeah.
this
Right.
new account, and
Right.
we could be talking not accurately, folks. So
Yeah.
just pay attention to how these rules shake out as
Because,
more and more data comes
like
out.
I said, this one you literally cannot take the funds out of
Yep.
Right.
until they're 18. It's
So maybe
tied
you
to that.
can't convert, but I would imagine.
So I
you
don't
could.
know that you can convert every year until they're 18.
It'd be interesting to find out. I'm excited.
Because then you would have to watch that Roth, because those funds in that Roth wouldn't be able to be withdrawn. In the Roths, you can withdraw.
I would imagine that they would have some sort of Trump account that was a Roth option if they allowed it. You know what I mean? Because that'll be locked down. Same thing.
Somebody will
So-
figure it out.
Yeah. Or it's just like, well, let it grow tax deferred until 18, because then the government gets more money on the conversion.
There you go.
I just
mean,
think
that's really what
It's
happens.
kind of exciting. So
All right.
Yeah,
Well-
that's a big one.
That is a big one. That one is exciting. So there's a lot of changes, a lot of good, we're not sure yet. And we'll see kind of how this goes out. Leasa, anything else that you want to make sure everyone's aware of, or questions that you're wondering about that you're thinking
well, I think
we all
some
need to be
people are
thinking about?
excited to get to take auto interest. They can take their interest on their auto loans now.
Oh,
Quick question. Mm-hmm. That's if they're purchasing. Do they get something if they're doing a lease?
No.
So this is only for purchase interest on debt from purchasing.
And new.
oh,
Got to
and
be new.
It's got to be new.
Got to purchase it.
Gotta purchase it.
No campers, no motorhomes.
Okay.
You're going to have to provide the VIN
Shucks.
number,
Yeah, I don't know.
and you're going to have to get the interest amount from your lender.
Okay.
So think like your 1098 you get for your mortgage. Something similar to that will have to be issued. You can't just randomly put a dollar figure
Can't
in
say,
there.
Oh, I had this much interest.
Yes.
But it has
Trust
to
me.
be but the vehicle has to be brand new.
Yes.
Oh, okay.
Is it? Does that
And
start?
it's personal use vehicles.
Yeah.
No
But it's like my
business?
son bought a car and he's still making
Correct.
payments on it, but he bought a used car, so that wouldn't count. That's interesting.
And one you've already bought doesn't count.
Right.
so
you can't-
personal.
Refinance it in account.
Right. Personal, brand new.
Personal, not
Brand
business,
new.
brand new.
Non-business.
Okay. Well, I mean, you kind of figure out you can kind of think about what they're trying to incentivize here, right? They want us to buy new cars because those come fresh from the factory, and all that kind of stuff. I
And-
can see.
and
it
it's
kinda
gonna be-
makes sense.
You don't have to itemize to get this one.
So you can just include that. That's nice to know. Okay.
So while you're talking about incentivize for business owners out there, if you are a manufacturing business, you're going to be able to expense the entire cost of building your building.
I know.
If you do a brand new building, the offices that are in there, you can't expense, but the whole floor cost to do manufacturing.
I have a really big question for you after this is over.
Yeah.
About some of
All
that
right.
stuff.
But I think that's incentivizing because they want manufacturing back in the U.S.
So then if I sell this building and build a new one, I could expense that whole building.
You're not manufacturing here.
Oh, only manufacturing.
You're only making
manufacturers.
money here, Roy. That doesn't count.
Holy
You
hell.
gotta make some
I only
widgets.
have money trees around here.
You gotta make
It's
some
an
widgets.
orchard. We water it every day.
No, it's got to be manufacturing.
Darn it.
Okay. Well, that makes again. You can it's always about the incentives, right? So that's the tax code is always about
manufacture
incentive.
pizzas.
There.
Does that count?
And I think they're also incentivizing farmers because now if you sell to a farmer, a legitimate farmer who's going to use the land for farming, he gets a break on how he has like 4 years to pay the tax instead of having to pay the tax the whole year.
Oh, okay.
If you sell to a person that is going to be a farmer and is a U.S. citizen
And is actually going to farm.
and is actually going to
So
farm.
China
you know-
can't come in and buy your
So,
farm.
correct.
That's kind of nice because there's a lot of incentives, especially in our part of the world here in northern Colorado. There's a lot of existing incentives that incentivize people to turn farmland into housing and other things. So it's kind of nice. We still need to grow food.
Yeah. So
there's no real tax break per se. It's just elongated on how they can pay it.
yeah, they got 4 years
Got it.
basically to do it.
It's something.
Yeah.
All right. Well, this has been really interesting, as I knew it would be.
Well, I want to know, does she have anything else? Because I'm like, man, she keeps dropping dimes on us.
I know. Okay. All right.
We got a little bit of time, right?
We got a little bit of time.
Couple
We have a
minutes
little
here.
bit of time. Let me look at my notes and see what else I missed.
Yeah.
So while you're looking that up, this is a big deal for a lot of business owners to be able to know what the parameters are on what they can deduct and not deduct, and that decisions they're making, right, on how they're moving forward is something I'm already seeing business owners talking about.
Well, and what they're going to have to start tracking, like with the overtime and the tips and everything. Like, there's a lot of things they're probably just not used to tracking that they now.
Payroll providers are largely going to be dealing with that, probably.
Yeah.
Yeah.
Who's tracking what? So.
And along the lines of things that you have to report, we've all had to report 1099s for years now since it came out for $600.
Mm-hmm.
And then they came out with that 1099K. So when you were doing work at Etsy, or I think my fantasy football guy got caught in there because he used his credit card there. So they sent out a 1099 saying you had 20,000, or you had 20,000 in income or 200 transactions. And they reported on that. Well, they came out with a rule a couple of years ago that they wanted those for 600. They wanted them for the same 1099 amount. So we don't get any relief in 2025, but in 2026, it goes back up to the 20,000. So you have to have at least 20,000 before places like Venmo or Zelle or those kind of things are going to have to send those out. Okay,
wow,
so
that's a big deal.
it's gone back up. There's a little bit of relief for the 1099 people that did 1099 and miscellaneous or 1099 NECs. Not in 2025, but in 2026, it'll go up to 2,000 above the 600.
Oh.
So you used to have to send them out to every service provider that you paid more than $600.
Okay.
Now it's going to be 2,000, which is good.
Yeah.
It's going to be indexed every year, so it's going to go up, so we don't get stuck with the 600 that we've had for 20 years.
I'm trying to think. I know I get 1099s from like YouTube and for ads on my YouTube videos, and like from Amazon for my referral stuff. It all comes 1099. I think it's NECs. I'd have to go back and look.
Yep.
So, yeah.
But the NEC rule was $600. Now it's going to be 2,000. And technically, whether you get one of those or not, you're supposed to claim it.
I write it all
Of
down.
course he does.
Of course I do.
Okay.
You can't trust a pastor. Who can you trust? So, all right. Well, you do keep dropping dimes of wisdom on us, Leasa. I love this. This is wonderful. Thank you.
Yeah. So
There you go.
Any other fun thoughts before we let you go?
I was trying to think, if you're in the business world, we're going to have permanent bonus depreciation, which I find exciting for my businesses. But some of you all don't know what bonus depreciation is and don't care.
Don't have a clue.
Both of us are looking. I don't even know what is bonus depreciation.
So
Is that when I get the Christmas card from my church with some $20 bills in it?
no, depreciation in general for a business is, let's say you buy a car and let's say it's $50,000. You can put the car on the books and you can depreciate it over its life, which is 5 years. So you get 20% of it every year for 5 years. You can take Section 179, which depreciates the whole thing, or bonus. You can also, we'll just flat out, you can just do it without having to elect Section 179. Bonus is something you elect out of. Section 179 is something you elect into. And so it gives me the ability to play with how large I want your expense or how little I want your expense with these two rules.
So they can, in that example, $50,000 vehicle, they could write that all off in 1 year?
Yes, with Section 179, and bonus is going to allow them to just do it unless they say, I had a bad year. I don't want to take the whole $50,000. I want to use it in the upcoming years, and then we elect out of. The funny thing about bonus is you have to elect out of the class life. So Section 179, you pick the asset and say, I want to totally depreciate this asset. Bonus is this class life. So everything in the 5-year class life, you have to either take bonus on or not on.
Oh.
This is, folks, why you need a CPA.
Right.
Because Jeremy and I are looking at her a little bit cross-eyed right now.
So go back to our
But
CPA.
we need good professionals in our life like Leasa to help us stay on track and make sure we're doing the right decisions. And, there are manipulations we can make within the rules to benefit you the best we can.
Yeah.
And that's the goal at the end of the day.
Yep. Yep. We talked a lot about that. We talk a lot about that on this podcast, dealing with the tax situation and making it work to our advantage as much as possible. And now with some pretty dramatic shifts happening.
Some of it's fun.
And
some of it,
it'll be, you're going to be a busy person for the next couple of years.
When should people start? You have a client, you have a book of clients. When should your clients start kind of reaching out to you to have conversations about some of these things? Should it be before year end?
Yes. So some of these things I will be sending out like an email to my clients saying, hey, I have this, and trying to do just a summary of, if any of these catch your eye that this is something you're dealing with, I'd like to talk to you about the rules.
Right.
Some people think that I can do the whole client list and pick and choose and say, hey, this is coming in, it applies to you. I just don't have the brain power to do that for each individual. So it will be a sort of a generic list. These are the things I think are exciting that I would like to talk to you about before year end.
Yeah, because there might be some shifts or something you need to make before year end, because you can't do everything on the back end.
If you had a good year and you need to buy a vehicle, do it before year end because you could write it all off in 1 year.
Those I'm not so much worried about as my charity people.
Yeah.
I'm really
just so they can know the impact.
I just want them to have that, to know that next year there's going to be a problem.
So maybe bunch it if you can this year, if they have the money. Yeah.
Right.
All right. Well, thank you for joining us again. First repeat guest, and I think it went smashingly well.
Oh man,
somehow
this is a lot.
I don't think this is the last time we're seeing Leasa.
I don't think so either.
I don't think so. So you're gonna have so many mugs by the time you're done. So if you don't know this, if you're an audio listener, if you come and appear as a guest on the podcast, you do get an amazing Credentialed Wealth Advisors Yeti mug.
It is quite nice.
It's a very
high
nice
demand.
It's a very nice mug.
Yes,
it
if
really
you see
is.
somebody with them, they've been on the podcast.
That's right.
That's the only way to get them.
Yeah, pretty much.
Yeah.
Becky has one, but she works here, so.
So you're not handing them out to your clients.
No. Not these. These are podcast only.
These are podcast exclusives.
Yes.
So
okay,
I barely got one, and I've been in almost all of them. So there you go.
Yes.
All right.
High class around here.
Well, thank you guys. This is going to be a great one for our listeners at home to share out and about, especially right at the time of year that this is going to be coming out. It's going to be top of mind, ending the year in taxes and all of that. So do share, as we always ask you to do, with friends and families and those you might know. Like and subscribe if you got a question or comment about anything, especially if you're on the YouTube side of things. If you're watching it there, put that comment in the question or comment down in the comment section. We do see those and take those into account for future episodes and things like that. They're just really helpful, so please do that. All right. Well, thank you, Leasa. Thank you, Roy.
Thank you. Been great.
Thank you, guys.
Always.
It was fun.
All right. We'll see y'all later.
CWA is a Securities and Exchange Registered Investment Advisor. No content contained herein should be construed as an offer for investment advice or an offer for the purchase or sale of any security, insurance, or other investment product. Investments involve the risk of low loss, including loss of principal. Please consult with a qualified financial, tax, or legal professional before implementing any strategy presented here. Data presented here are obtained from believed reliable sources but cannot be guaranteed as to completeness or accuracy.